So in 2025, interest rates have been slowly going down, inventory has been going up in Yorba Linda, and on top of that, affordability is actually better at the end of 2025 than it was at the beginning. So what does this all mean as we head into 2026 for the Yorba Linda housing market? That's exactly what we're going to talk about on today's 2026 housing market forecast for Yorba Linda. So let's go ahead and get into it. So every year I begin the year by doing one of these videos, and I always have to start out by saying the same exact thing. This is a forecast. I do not have a crystal ball. Unfortunately, nobody does. So we don't know exactly what's going to happen in the housing market. There's just too many variables to be able to predict. However, what I can do is I could take all the existing data out there, as well as what I'm seeing on a daily basis on the ground as I'm going through transactions, and take into account all the top housing experts' predictions for what they think is going to happen in 2026, put all that information together for you, and give you the best idea of what you might be able to expect as we head into this year. So let's go ahead and first talk about what impacts the housing market by far the most out of everything out there, and that's interest rates. So at the beginning of 2025, we actually had interest rates starting above 7%. However, through the year, we gradually saw interest rates go farther and farther down, and over the last 100 days, we've actually been averaging under 6.5%. Interest rates have been typically fluctuating between 6.2 and 6.4%. So heading into 2026, we're actually going to be starting the year at basically a full percentage point lower than we were last year, which is why affordability has actually improved so much, is because your money goes farther when interest rates are going down. So what can we expect interest rates to do as we head through 2026? Well, a lot of you might be thinking the Fed controls the interest rate, so if the Fed drops rates, we'll see mortgage rates drop as well. You might be surprised to know that the last 3 drops the Fed did in 2025, mortgage rates actually went up. And the reason is the Fed controls interest rates that are short term. So think of things like personal loans, car loans. Those type of things are what are immediately going to be impacted when the Fed actually reduces rates. However, for mortgage rates, that's more of a long-term loan, so what that more closely follows is what the 10-year Treasury is doing. Because typically, people are holding on to their house for about 10 years, which is why those two are usually going to be going up and down together. In fact, since we started recording the difference between the 10-year Treasury as well as 30-year fixed mortgages, the average difference really hovers about 1.75. Now, after COVID, we actually saw the difference between the two jump up a full percent to 2.75%, which is one of the reasons why we saw interest rates shoot up. However, over 2025, we're starting to see that spread get a little bit more normalized. Right now, we're hovering at about 2.1% difference, and it has a little bit further to drop as well. So there's a good chance there might be a slight decrease in interest rates if the economy stays about the same as where it is starting 2026. Now, saying the economy is going to stay the same is probably a big ask here, because there's just too much going on right now to say that we have a stable economy heading into 2026. So what else impacts that 10-year Treasury that might drive it up or down? Well, the two biggest things to look at in terms of economic data are going to be job numbers and inflation. If inflation goes down, interest rates tend to follow. If unemployment goes up, interest rates actually tend to go down as well. So basically, if you want interest rates to go down, we're going to need to see unemployment go up, and at the same time, inflation go down. That's going to be best case scenario to see interest rates possibly in the high 5s by sometime mid next year. However, on the other hand, if inflation stays sticky and a little bit higher next year and job numbers look good throughout the year, you might expect interest rates to start going up a little bit and hover closer to that 6.4, 6.5 range. Now, I think based on the current data, there's a good chance that inflation is going to stay the same, maybe for the first couple months of next year, but hopefully start to go down after that. Unemployment numbers definitely look like they're starting to go up. Every time they make an adjustment, it seems like there's more and more people that are unemployed. So I think there's a good chance that we'll see a slight decrease in interest rates by the end of the first half of the year of 2026, if that comes true. Now, if you look at the top housing market forecasters, they're usually calling for about the same thing. So they're calling for interest rates next year to range from 5.9 to 6.4%. And again, right now we're hovering right around 6.2%. So you can see that most people are not predicting any major swings in interest rates next year. They've kind of settled down into these low 6 numbers and are predicted to remain very similar to that throughout the entire year. So now let's go ahead and shift to inventory. So yes, you might have read a news article that inventory is going up, and it definitely is, which is a great thing for buyers because they have more selection. On the selling side, that just means you have a little bit more competition. However, you want to put it into perspective. We still have numbers that are below pre-pandemic levels in terms of the amount of inventory on the market right now, so we are nowhere near what a 2008 housing crisis would produce. Right now, we're still trying to recover from COVID still in terms of getting getting enough housing on the actual market for buyers to be able to choose from. Now, when you look at what most housing economists are predicting for next year, they are predicting that you're going to see anywhere from a 5 to 10% increase in inventory compared to the previous year, and there's a couple reasons for that. So number one, and I thought this was kind of interesting, you can check out this chart right up here, but this did a survey of current homeowners, and they're basically trying to survey them to figure out when they might consider moving into a new home based on what interest rates are doing. So you can see here that when interest rates are at 7%, only about 14% of homeowners would consider making a move. However, when that went down to 6%, that jumped up to over half of them. And again, interest rates are hovering around 6.2 right now. So there's a good chance that you're going to see some of these homeowners that were sitting on the sidelines over the last couple years start to finally say, hey, I've had 2 more kids since the pandemic. This 2-bedroom home doesn't work for me anymore. I need to find something larger. Or some people even downsizing, saying I have way too much home. I don't want to take care of it all. I want to get into something smaller. And now the payments make a little bit more sense. Now I might consider putting my house on the market. So because of this, as long as interest rates stay in those low 6% range, there's definitely a very good chance you're going to see more homes to choose from as we head through 2026. So what does this mean numbers-wise for Orange County? That means over the year, you're probably going to have another 2,000 homes hit the market for buyers to choose from. And those numbers will break down differently depending on the city and the size. So for instance, in a smaller city like Yorba Linda, maybe you can expect an additional 100 homes to hit the market over the year than the prior year on there. So the good news is buyers are going to have more to choose from. On the selling side, the bad news is you'll probably have a little bit more competition next year than you did this year in terms of trying to sell your home. Now, on the opposite side of things, the demand side of things, again, like everything in this video, it's all going to come down to what interest rates do. Now, I don't have a graph to show you this, but if you look at the amount of mortgage applications that happen when interest rates go down closer to 6%, they definitely jump up whenever that happens and more buyers into the market. So we're going to have a similar situation with demand because as interest rates go down, affordability goes up, more people can afford to actually purchase a home, so therefore you're going to have more buyers in the market. So that 6% seems to be about that same limit. Same thing with the sellers, where you're going to have a lot more people start entering the market because homes are more affordable again. And again, because we've had rates so high for so long, when we have rates down to 6%, it starts to actually seem more normalized now than it did when we had rates in the 2 and 3% during COVID. And if you look at the historical norms, 6% is really not that much different than what you typically see in a normal housing market. So I think buyers that have been sitting on the sidelines hoping for those 2 to 3% interest rates again are probably starting to come to the realization that those type of rates are just very unlikely to ever happen again in our lifetime. So buyers that have been sitting on the sidelines are starting to get back in the market and start looking for homes more actively as we get down to that 6% range for interest rates. So we talked about interest rates, we talked about supply, we talked about inventory. So what does this all mean for housing prices as we go through 2026? Well, if you look at the interest rates, they've normalized, they've stayed pretty steady over the last couple months, and they're predicted to do so. On the demand side of things, demand is still low because of affordability, but it has been going up because interest rates have been going down. And on the supply side of things, again, supply is still low compared to where we usually are. However, that is starting to go up as well. So because both of these are going up about the same rate at the same time, this means that we're going to have a housing market that's most likely pretty stable going through 2026, where both buyers and sellers are going to be on pretty even playing fields in terms of placing offer, negotiations, and leverage when you're going through a transaction in 2026. Now, when we look at some of the top analysts in the housing market space, most of them are predicting appreciation of anywhere from 1 to 4% over the year for 2026 in the national housing market as well as the Orange County housing market. So these are a little bit lower rates than you typically see, usually around 5 to 6%. However, wages still have a long way to catch up to make homes affordable again. So you're going to be looking at muted appreciation over the next couple years because of that. So the important thing to know is that the housing market is still on stable ground right now. We'll see appreciation most likely happen by the end of the year. It just won't be as significant as we saw during those COVID years. That will probably never happen again as well. But we will see slow appreciation happen over the year as both buyers and sellers hop into the market. We should have a pretty active spring market, a pretty active summer market before it falls as we go into fall and winter, which is what we see in a normal market in Southern California. Now you might be saying to yourself, but I saw an article saying housing prices are going to crash 30%. I should wait to buy. There's going to be a housing crash worse than 2028 around the corner. These are clickbait articles. There is no indication by any means that you're going to see housing prices go down like that, because to have housing prices drop that dramatically, you need three things. You need an excess amount of inventory, you need low demand, and you need sellers that have to sell their house and they have no other choice. Right now, we do have low demand. We have one of the three, but when you look at excess amount of inventory, again, like I said before, we still haven't even caught up to the normalized market in terms of the amount of inventory we have on the market right now. We're still below pre-pandemic lows. And in terms of sellers that actually need to sell their house, yes, foreclosures have gone up. However, foreclosures are actually at a pretty normal rate right now compared to a standard healthy housing market. So yes, they've gone up since COVID times, but they're at the rates right now that you would generally expect to see in a balanced market. And there's really no indication that foreclosures are all of a sudden going to jump through the roof for a lot of reasons. So number one, homeowners right now have more equity than almost ever before in their homes. 40% of homeowners have their homes already fully paid off, and out of the remaining that still have a loan, 70% of those have 50% or more equity in their house. So if someone needs to sell their home before going into foreclosure, they're just going to put it on the open market, get a market value price for it, sell their home, and move on, whether they have to lease for a while or do something else. They're not going to be selling it at extreme discounts, and there's just not enough inventory to drive those prices down significantly. And in terms of current homeowners that need to sell, a lot of current homeowners still have really low interest rates, so needing to sell is something that they really don't have to do. In fact, 70% of homeowners that have a mortgage have a rate at 5% or lower, 50% actually have a rate at 4% or lower, and 20% still have rates at 3% or lower. So 1 in 5 homeowners actually have an interest rate at 3% or lower, so they really don't want to lose those interest rates. There's still going to be plenty of homeowners on the market that don't want to sell their house because financially it just doesn't make sense for them to move right now. And on top of that, the amount of time homeowners are spending in their home is actually growing, making inventory harder to find because of that as well. And the final thing I'll say on foreclosures and all of that hype out there that it's going to be a giant wave and you're going to have people start losing their homes. If you look at what happened after 2028, mortgage loans have become much harder to get. You have to be much better qualified. And so the people right now that have a home are going to have some of the highest credit scores out there, have some of the best debt to income out there for those loans. And there's a large portion of them that are not going to default because they're overqualified to buy those homes, especially compared to the type of loans they were giving out prior to that 2008 housing crash where they were just giving loans out to everybody. So the people that have loans are extremely well qualified. They have a lot of equity built up in their house, and they most likely have a very low interest rate. That doesn't equate to people that need to sell their house. So again, going back to those three things, the chances of inventory skyrocketing and the chances of people needing to sell their home and having no other option is really hard to see happening in 2026 to be able to see any type of major correction happen in the housing market. However, that's definitely not to say that there are no risks to the housing market next year. The two things that you definitely need to be paying attention to in 2026 in terms of risk that I think could really impact the housing market is number one, interest rates going up. So if we see inflation start to creep up next year and at the same time job numbers seem to stabilize and not look too bad, we could see interest rates go above what most people are predicting, above that 6.5%, closer to 7% again, and that's when things are going to start slowing down and we'll see some depreciation happen most likely if that does come to fruition. Now, I don't think that will happen, but it's always an option that you want to be paying attention to and watching that economic data come out to make sure you don't see those trends start to happen where rates start to go back up. And the other thing, and this is something that's on the minds of a lot of Southern California homeowners, is insurance. Insurance premiums have been skyrocketing over the last couple years, and it doesn't seem like there's any end in sight. Especially those that are closer to fire zones are having their insurance either canceled, doubled, tripled, quadrupled, and this is impacting how affordable homes are getting. So even though the actual mortgage payment is going down in terms of your principal and interest, the average payment for a home could start increasing more if these insurance rates continue to creep up. And this doesn't only impact single family homes, it also impacts homes that have HOAs, condos, those type of things as well, because as fire insurance goes up for condos, they have to increase their HOAs, which is why you're starting to see the average HOA in Orange County hover closer to the $400, $500, $600 range than 10 years ago where they're maybe $200 to $300. So I think home insurance is probably the number one threat to the Southern California housing market as we head through 2026. And they've been trying to figure it out and trying to find ways to lower it by allowing more insurance companies to come back and be more competitive again. However, we really haven't seen that come to fruition yet. And we really haven't seen insurance rates drop. And I really don't expect that to happen in 2026 or anytime soon. As more and more risk is put on these insurance companies, they're going to increase their prices and they're going to continue to ask the state to increase the prices more and more and more. So it's something that you need to account for. So the two things you need to do if you're trying to buy a home right now is always get an insurance quote up front before you decide to place an offer on a home, so you know what you're dealing with, and then always have a buffer in there as well, knowing that rates are probably going to go up over time. So you don't want to be maxing yourself out and then you're not going to have enough money if all of a sudden insurance is going to charge you an extra $50, $100 a month to be able to get insurance on that same home. So what does this all mean for buyers and sellers as we head into 2026? Well, on the buying side of things, it means you're going to have more homes to choose from this year than you did last year. And on top of that, your affordability is going to be a little bit better as well because interest rates are on the decline. So that's going to be a benefit for you when you're going out there looking for homes. You might not have been able to afford a home last year or very close to it. This year, it might be possible for you to purchase that dream home based on the current conditions of the market. The biggest thing that buyers need to understand is that it's still going to be competitive out there, especially for those homes that are move-in ready, that are turnkey, and they're priced under $1.5 million. Those homes typically drive the most amount of traffic to it. So as a buyer, if you're thinking of purchasing and maybe you're even a couple months out, what I highly recommend doing is you need to reach out to your trusted lender, get that pre-approval started where they're taking your documentation for your financials, looking it over, and giving you a better idea of what kind of monthly mortgage payment you can currently afford. And if you're not there yet, they can help create a plan to help get you there and give you a roadmap of what you need to do so that way when the time comes, you're ready to go. Now, when you get that pre-approval up front, that's going to give you the opportunity that if that perfect house comes along, you can place an offer on it. It could be competitive right away versus having to scramble, try to talk to a lender, wait a day or two to get that pre-approval, and then all of a sudden someone else slips in, grabs that home from under you, and it's in escrow before you've even got that pre-approval from the lender. So to prevent that, talk to a lender. It's completely free. It doesn't impact your credit score to talk to them, to have them run your financials, to give you a better understanding of your current situation and what you may or may not be able to afford. And the second thing that I always want to stress is when you talk to a lender and they tell you what you can afford, you always want to double check that based on your current budget, because they're going to give you an idea of what you can qualify for. However, that might not be what you want to spend on a mortgage. You might want to be more conservative than that, and you won't know that unless you start budgeting and start looking at your monthly income and what's going out every month to make sure that you're going to be comfortable with that mortgage payment. So two things you need to be doing: talking to a lender and sitting down at the table, looking over the last couple months of your credit card statements and figuring out how much is coming in, how much is going out, and what you can cut if needed to in order for you to afford that mortgage. So that way, if you do get into escrow and you do purchase a home, you're not going to be what we call house poor, or you're not going to be able to go out to the movies or go out to dinner because all of your money is going to your mortgage. You want to make sure you have some breathing room, some room to have some savings still, so you can feel comfortable living in your new home. Now, on the selling side of things, there's a good chance that you're going to have more competition this year than you did last year, which means for you, you need to make sure your house stands out compared to anybody else's. So some things that you could be doing to prepare yourself to sell your home, this is usually happening a month or two at least in advance, is number one, talk to your real estate agent, have them walk the property with you and figure out some of the things that you might be able to do to your property while you're getting ready for sale that's going to be the best ROI. So whether that's just cleaning the house, getting it ready for photos and videos, or maybe doing a quick paint job on the inside or outside, doing some quick landscaping, what's going to give you the most return on investment for the money that you spend. It's easy to talk to a real estate agent for that. It's completely free. They'll walk through your house. They should be able to give you a checklist of what you could be doing in each room to really go through and maximize the amount of buyers that are going to see the house, like the house, and put an offer in on your house. The second thing that you might consider doing is something called a pre-inspection, where you have a general inspector go out to your house far before you want to put it on the market and just give you a general report card of what might be wrong with the house to see if there might be things that you want to fix before putting it on the market. So that way you can get a higher price once it hits the market, as well as eliminate a lot of that back and forth negotiation that happens during escrow when the buyer's asking you to fix things that they found wrong in the property. You can really head that off by having that inspection done ahead of time, fixing some of those things, and then you have the option of giving that inspection report to the buyer and saying, this is the condition of our house, place an offer based on that, and that helps eliminate a lot of that back and forth negotiation that happens during escrow, where they're coming back asking for $5,000, $10,000, $15,000 to help repair some of the things that are wrong with your house. So that's something you consider doing as well. If you work with some agents, they'll provide that for you free as a service like I do. Other times you can just hire a general inspector to come through, usually around $500 to $700. They'll go through, check out the property, and kind of go through and give you that report card, and you can start looking at some of the things with your your agent that you can go through and fix to get your house ready for sale. Now, if you have been thinking of either buying or selling a house in Yorba Linda in 2026, but have some more individualized questions that you want answered, feel free to click the link below if you're watching this on YouTube and set up a free discovery call with me for 15 minutes. We can go over any questions you might have and give you more of a roadmap and next steps that you could be taking to get yourself where you need to be in order to be able to purchase or buy a house this year in 2026. Again, completely free, no pressure. It just helps get some of those questions answered and maybe get some additional information on questions that you didn't even know to ask. So if you want to set that up, look at the calendar link below, pick a time that works for you. I'd be happy to talk you through it. And if you're not quite ready to take that next step yet, no worries. You can also look at the description below and sign up for my weekly Yorba Linda newsletter, where I go over everything that's happening inside Yorba Linda, the events, the new restaurants opening up, but I also go over what's been happening in the housing market each week, so that way you can stay up to date on that as well. And if you don't currently live in Yorba Linda, but you're thinking of moving here, I have 2 additional resources for you. Again, in the description below, you'll find a free relocation guide that goes over everything you need to know about moving to Yorba Linda. And then number 2, if you check out this video right here, it goes over the pros and the cons of Yorba Linda to help make that decision a little bit easier to figure out if this is going to be the place for you and your family. So until next time, stay happy, stay healthy, and I'll see you on the next show. Bye, everybody.